Hey guys, super excited to talk to y'all today. I think that we're gonna cover a lot of good material. So, without further ado, let me just let y'all know that I'm gonna be talking about trading today. I know that there's been a lot of news recently, about Reddit and GameStop and all these companies and hedge funds losing a bunch of money. Now, this isn't the only way to make money if you're like in kind of finding some loophole. There's definitely ways to make money in trading rather than, just jumping on the bandwagon. So before I get into it, let me just welcome everybody. Welcome to Let's Talk Business. All right, so we said trading. Now, in trading, there are options. An option is the opportunity, not an obligation, to buy or sell at a specified price and either before or on a specified date. So let me break that down even more. Each one of these options has an expiration date. So that means that you buy at a certain date and you know for a fact when the end date is, whether that be 5 minutes from now, 2 weeks from now, 3 months from now, whatever it is. Now, when I also say a specified price, y'all will actually see that you will make a call option or a put option at a specified price. So you think that the price will either go past a call option, past that price, or below that price, which is a put option. I'm not going to be giving out any crazy analogies talking about bananas or monkeys buying bananas or anything like that. I think I've seen enough videos where they try to use crazy analogies and it just honestly confuses me, which I already know what a trading option is. So I'm just going to break it down in layman terms and, kind of just slow the roll and also just explain to y'all straight up what it is. So I drew out two graphs. One that represents a call option and a second one that represents a put option. Hey guys, I know that y'all probably realized that I changed my shirt and everything, and it's just because whenever I was recording this, I didn't realize that it actually popped up backwards on my camera, so I am redoing this part. But nonetheless, okay, so what I went ahead and drew here is our two options. And I'm gonna just go ahead and use Google as our stock, as our example stock, and what exactly, a call option is and exactly what a put option is. So first I want to explain to you what this graph even means in the first place. I know people always steady see, like lines on the graph. Well, if you don't know, just a quick clarification. Up and down on the y-axis, that means that it's like the value of the stock. So the higher that it goes up, the more valuable that the stock is, obviously. And then this line, this x-axis, this actually represents time. So what I went ahead and did, just drew a dollar sign and a clock, just so y'all are able to see and not get into any specifics. The picture on itself, this is just showing you an example of a call option going exactly how you would like it to go. So whenever you do a call option, let's just say this point in time right now, we are at point X. Sorry, let me go ahead and write that. And we're going to call this point Y. Okay, so let's just say we are at point X at this point in time. And we predict that this value of that stock is going to be rising within the next few weeks, for example. So we put out a option, a call option, because we predict that it's going up. So whenever you put a call option out, this actually allows you to have the option to buy this stock at value X, but further down the line. So in this point in time, and in this scenario, if things were to go beautifully like we thought it would, it rises in price, and obviously the value of this stock is at Y. And it's way more than it was at value X. So what this option allows us to do is we actually buy this share at value X, even though it's at value Y. So then the money made is actually everything in between right here. So this is money made. Okay, and then now let's go ahead and jump into the put option. Put option is the exact opposite. This is, let's just say that it is Google stock again. Google for some reason is going down in price, and we predict that it's going to go even further. So what we do is we get a put option. At point X, we buy the put option, so we see that the value is much higher than what it ended on. In the put option, you actually sell immediately and promise to buy back those shares to give them back to the person that they rightfully belong to. So, as you can see, it drops in price, and the money made is everything in between. Everything right here, that's where the money's at. That's where the money's at. You want it to go down. But if the complete opposite happens, so let's just say, I'm just going to go ahead and erase this call so it doesn't confuse us. Let's just say that we actually did a put option and it rose in price, kind of like how all these companies did. So whenever it rises in price, we sold, let's just say this is a put option, so we sold immediately at point X thinking that it was going to go down. But instead, it actually rose in price. The value of this stock obviously has gone up, and since we promised to buy it back, these huge hedge fund companies decided to cut their losses and bought it back at point Y. So then you could see that the money lost is actually everything in between right here. That is the money that they lost. And since they had more than one contract, obviously they had tons of contracts for each one of these companies, then they lost billions in just a matter of days. Now you know the details of a put and call option. We can go back to the video and y'all will see me change one more time. So now that y'all know what options are, this means that y'all can honestly do some of y'all's own research into companies, whether that be, any kind of information. There's two things that affect a company. The first thing that I always look at myself is the economy. How is the economy doing? And a good way to look at how the economy is doing is look at index funds, whether that be Dow Jones, whether that be S&P 500. Those companies are usually like a good indicator on how exactly the market is doing. Now, there's something called beta. So let me touch up on beta. What is beta? Beta shows how much the company will move almost synchronized with the economy. So if the economy goes up 1%, will this company go up 1%? Will it go down 1%? How does that usually work? And this is what beta shows you. Beta can go from -1 all the way up to whatever number. -1 just means that they move in the opposite direction as the economy. So a good example is gold. Gold actually has a negative beta and moves in the opposite direction of the economy. So usually they have, if you put them side by side, their graphs are usually looking opposite. If the economy goes up 1%, the gold goes down almost by 1%. And vice versa, if it just kind of fluctuates and moves opposites with something that moves in sync with the market. That's usually, like I said, your index funds that you can honestly use to almost indicate where the economy is at and where it could be. It can go past 1. 1 means that it is perfectly in sync. Anything above that means that it moves faster than the economy does. So let's just say, for example, oil and gas companies usually have a higher beta than 1. So what this means, if the economy were to go up 1%, the oil and gas industries will actually move more than 1% up. So I think Shell is currently at like 1.5. Exxon, exactly the same thing. Bless me. Thank you. So let's just say that the beta is at 1.5 for Exxon. So what this means is that the economy goes up by 1%, and Exxon is going to go up by 1.5%. So for every 1% the economy goes up, this goes up 1.5%. So that's honestly a good indicator on what exactly at least an idea of where that company is going to be going. Now, of course, you're thinking to yourself, well, that's not always the case, and it's not. You're right. So the second factor that comes into play is firm specific news, whether that be they hired, like I said earlier, they hired a new CEO, they haven't handled their finances well, or they handled their finances greatly, whatever the case may be, they got caught with fraud, whatever. Firm specific. That has absolutely no play into the rest of the economy or any other company. It's only specifically for that one. So now that y'all know what factors to take in consideration, y'all can honestly do y'all's own homework. I know that y'all are more interested in certain companies that I personally have absolutely no interest in, or at least have news about them, whether it be that they're coming out with a new product, a new model, they hired a new CEO, or whatever it may be. That firm-specific news comes into play greatly. The economy and beta is just one way on how to look at things. So a great example is actually this pandemic. Everybody was saying that, the pandemic was hitting, we were going to go into quarantine, etc. I knew that the economy was going to do bad, so then anything with a beta of 1 or greater was going to do just as bad or even worse. So the move to make is actually do a put option against all these companies. Now, if you're ahead of the curve, if you do this before it even shows any kind of drop in price, then you're gonna get these contracts very cheap. So on options, you actually try to get into things a little early and not late, because the later you get into things, the more expensive it'll be. So if there's already a trend showing, you're probably gonna get these options much more expensive. For a simple example, right before the pandemic happened, I had got a put option for Ford. This put option was worth $4. Just one contract worth $4. As time passed on, obviously, pandemic happened. Everything dropped in price. So I actually turned those $4 into close to $300. That was just one contract. So if I had bought more than one, obviously that it just multiplies by how many contracts you actually have. Another example is, let's just say the pandemic again. The pandemic just happened recently, so we can all relate to it. Since the economy was predicted to drop so much, it would be a great time to invest in gold, or even do a call option for gold, just because since gold moves in the opposite direction and has a negative beta than the economy, then it just skyrocketed while the market plummeted. So there's just another example on how to predict things. Honestly, I think that that's just about it. Y'all could break it down even further if y'all like. Obviously, there's a lot of information in this, but I think that, I did y'all just. Y'all can honestly just look over things and do y'all's own homework. Like I've said over and over and over again. If y'all do y'all's own homework, it will definitely pay off. So the more you know about a company, even better. I'll see y'all later. Thank you for joining my channel. I'll see y'all. Peace.